The easiest way to invest is to invest in index funds using the dollar cost averaging strategy. The average person is afraid of investing because 1, they don't want to lose all their hard-earned money. 2, they don't feel they have enough knowledge about the market in order to invest in it. And 3, they just see it as a huge hassle and rather just not go through with it. What if I told you that this strategy that I'm talking about is backed up by math and data? It does not require you to be sitting in a computer looking at your portfolio 24/7, wondering when to buy or when to sell. And 3, it guarantees your fair share of stock market returns. I know, it sounds too good to be true, it sounds awesome, sounds amazing, kind of makes me look like a wizard, but no, this is actually backed up by data. So if you want to see how this foolproof strategy works that anyone can do, even my dog, then make sure to keep on watching. I'm Alex Marie, welcome to my channel, the one-stop shop for all things business, finance, and personal development, and today we are talking about the easiest way to invest, also known as investing in index funds, with the dollar cost averaging strategy. I have 2 goals with this video, and that is to 1, inspire you to start investing now or as early as possible, and 2, show you that investing does not have to be hard. So if by the end of this video I manage to do those 2 things, then you have to give this video a like and share it with someone who you think will benefit from seeing this video. Now this is the way I choose to invest, and let me show you why that is. Investing 101 will highlight the importance of diversifying your portfolio, and in school they used to teach this with an example of eggs in baskets. So it's very simple. Basically, you don't want to put all your eggs into one single basket, because if that basket were to fall, you'd lose all your eggs in one go. However, if you spread out your eggs into multiple baskets, then if one basket falls, you still have a lot of other baskets filled with good eggs to rely on. That's how investing works. Basically, you want your portfolio and your money, or your eggs, to be spread out across different baskets, which are assets. Because if you were to put all your eggs or money into one single asset and that asset falls and crashes, then you'd lose all your money, and that's not what we want here. And diversifying your investments can be something that takes time and knowledge, because you have to do your research in order to decide which assets and stocks you want in your investment portfolio. But there's actually a way to diversify automatically, and that is using index funds. Index funds are portfolios of stocks or bonds that mirror the assets held by financial market indexes. And financial market indexes are basically a hypothetical portfolio that holds a set number of assets that represent a segment of the financial market. Market indexes represent how the market is doing. So for example, if you want to know how the US market is doing, you would look at the S&P 500 index, which is calculated from the price of the stock from the 500 largest companies in the US. And I know I'm probably speaking alien language because this can be something a little bit tricky to understand. So let me talk a language that everyone knows: cake. So when you bake a cake, you have numerous ingredients. You have the eggs and the sugar and the milk and the flour and so on. And when you eat a piece of cake, you're actually eating like a little bit of all those ingredients. And that is how index funds work. So continuing with the example of the S&P 500. An S&P 500 index fund is a cake, and the ingredients are the 500 companies that it follows from the S&P 500. So when you buy an index fund, you're actually buying a small piece of all those 500 companies, otherwise known as instant diversification. So this is just to explain that when you invest in an index fund, you're not investing in just one asset, but multiple assets. Further explain how index funds work and their types of returns you can get from index funds, let's look at 2 index funds. So we're going to look at the Vanguard 500 Index Fund and the Fidelity 500 Index Fund, and both of these follow the S&P 500. Now looking at these 3 charts, we can see that they're exactly the same. They follow the exact same pattern, and that is because these 3 portfolios are filled with the same 500 companies. And that's why I choose to invest in index funds, because instead of having to research which companies I want in my portfolio, I can just choose an index fund that I like or that represents the entire market and call it a day, because my portfolio is diversified. Now that was the first part of this investment strategy. Let's move on to the second one. Dollar cost averaging is an investment strategy where you invest the same amount of money at set intervals for a set period of time. And this could be weekly, bi-weekly, or even monthly. And as an example, you buy $500 worth of Disney shares the 30th of every month. This strategy breaks away from the traditional buy when it's low, because with dollar cost averaging, you buy regardless of price. So it doesn't matter if the price is high or low, because you're gonna buy it anyways. Once you set your preferred intervals, you invest in those intervals intervals no matter how the market is looking. And the reason why you choose dollar cost averaging is to take away the emotion of investing, because investing is very emotional, especially when the market is crashing and all your portfolio numbers are in red and you see all your hard-earned money just poof, gone, disappearing. And because of this fear of losing their money, people sell their assets in a market crash, which is the one thing that you're not supposed to do rationally. Because instead of selling in a market crash, you have to hold on, buy some more if you can, and just wait until it gets better, because eventually your numbers will go back to green and all your hard-earned money is going to be back in your account and continue growing. But we don't think rationally when we're emotional and when we're scared of losing our money. So dollar cost averaging isn't emotional, it's mathematical, and it protects us from ourselves. But hey, aren't you supposed to time the market to make more money? Yes, but it's also highly unlikely that you'll do that successfully. Like, not even professional Wall Street brokers can time the market 100% of the time. And these people have access to data that we just don't have access to. So if not even professional Wall Street brokers can do it continuously, how can we? So the next best thing, which is super easy to do and will give you great returns, is to combine index funds and dollar cost averaging. To illustrate how this works, let's look at the investment returns from two different personas. And these two people will be investing in the same asset. They will be setting aside the same amount of money every month for investing. The only difference is when they're going to invest. So let's start with Taylor. So Taylor is someone who buys at the perfect time. She buys when prices are low, and then right after she buys, prices skyrocket, giving her awesome returns, also known as timing the market. And then there's Quinn, who buys into the market every month regardless of price. Now, the two of them are going to set aside $1,000 towards those investments every month, and they will be investing in an index fund that follows the S&P 500. And we'll be looking at a period of 30 years. When we look at Taylor's strategy, she's saving $1,000 every single month, creating a lump sum, and then buying in at the perfect time. And with this strategy, she ends up with $1,031,000. She invested only 8 times, timed the market perfectly because she bought low, and then after she bought, prices skyrocketed. Pretty sweet, considering she only invested $370,000. Now let's look at Quinn, and you'll notice that Quinn's savings column is in 0, and that is because Quinn is always investing in the market no matter what. So he doesn't save a lump sum, he's just investing it. And with this strategy, Quinn ended up with $986,000. And Quinn only invested $371,000. And you may have noticed that Quinn invested $1,000 more than Taylor, and that is because Taylor was creating a lump sum to then buy at the perfect time, whereas Quinn does the dollar cost averaging strategy, so they just invest no matter what and don't create a lump sum. And I know what you're thinking, like, hey, what's your point if timing the market clearly makes you more money? Here's the thing, it's impossible to time the market perfectly every time, because in order to time the market, you have to be constantly looking at the market and making predictions and deciding when to buy in, and you might not even get it right. Unless you can time travel to the future and take notes, which if that's the case, we need to talk over like a cup of coffee or something, because I need to know some stuff. It's simple. Timing the market is a gamble. Dollar cost averaging is mathematical. By Quinn using dollar cost averaging, they did nothing. Absolutely nothing. Just had their money invested on autopilot, growing and growing in the market. And by doing absolutely nothing, Quinn was only $45,000 behind Taylor, who did the impossible and timed the market perfectly. And dollar cost averaging works because when you wait to time the market and you create that lump sum, you're having this money in an account just waiting for the perfect time, and this money is just not growing. Whereas in dollar cost averaging, you just always have it in the market getting those returns. So it's always invested, it's always growing. So if you're risk averse, if you don't want to spend any time researching the market, looking at it, making predictions, or you're just overwhelmed and paralyzed with the amount of information and people on the internet telling you what to do with your money and how to invest, like me, then dollar cost averaging is the right strategy for you. This strategy is so easy. It's as easy as choosing the amount to invest, choosing an index fund to invest in, and choosing the frequency to invest. That's it. There's not a lot to it. So see, investing does not have to be hard, and anyone can invest. In fact, you should invest right now. Go. Open an account. Start growing your money. So did I meet my goals? Do you feel more confident in investing? Do you want to start investing now or as early as possible? And did you understand and see that investing does not have to be hard at all? If I did, remember to smash the like button in this video and share it with a friend. Thank you so much for watching this video. I hope you learned and enjoyed watching it. If you're interested in knowing more about investing and common sense investing, I recommend this book by John Bogle, The Little Book of Common Sense Investing. I will leave a link to it down below. Happy Thanksgiving for all of you who celebrated, and I'm very, very grateful for starting my YouTube channel and for all of you who watch me and keep learning. Make sure to check out the other videos on my channel, as I am sure you'll find something of interest to you. Make sure to subscribe to my channel for new videos every single Wednesday. And as always, remember that when it comes to finance, ignorance is not bliss, so make sure to keep educating yourself and keep learning about anything and everything, because education is everything. I sound like a broken record. Okay, I'm gonna go. See you next Wednesday.